The biggest risk to your portfolio may not be the stock market, it may be India's dependency on the world. I studied a powerful conversation between Shamani and Jayant Mundhra, where they discussed India's gold imports, manufacturing weakness, and AI disruption. Are we investing for the India story emotionally, or are we preparing for the India reality financially? The first lesson sounds like a gold discussion, but it is actually a portfolio lesson. Gold is not just jewelry, it is a currency pressure point. India imports a very large quantity of gold while producing very little domestically. When we import gold, we need dollars, putting pressure on the rupee. If the rupee weakens, imported goods like fuel and electronics become costlier. Excessive gold dependency becomes a national pressure point. Do not look at gold only emotionally. If your entire wealth is stuck in gold and real estate, you may not be building enough liquid financial assets. Gold can be a useful hedge, but for most families, it should be a part of the portfolio, not the entire portfolio. The second lesson is where the rupee story becomes personal. A weak rupee does not automatically mean strong exports. If India imports raw materials and technology, a weaker rupee also makes production costlier. Depreciation can hurt more than it helps. When investing in manufacturing, ask, does this company control its raw material, technology, and distribution? Avoid blind excitement. The third lesson is about inflation. Government numbers are based on a basket that might not be your reality. For urban families, the biggest costs are school fees, health insurance, and hospital expenses. These rise much faster than official numbers. If official inflation is 5%, your personal inflation may feel like 12%. A SIP is not just a SIP, it should be linked to a real future cost. The fourth lesson is about real estate. Many Indians want affordable homes, but the supply is moving toward luxury housing. The person who wants a home to live in is competing with the person who wants a home as an investment asset. Buying too early or with an oversized EMI can damage your financial life. First, build financial assets, then buy real estate from strength. At a country level and at a family level, dependency is the biggest risk. India depends on the world. Families depend on single incomes. To convert this into a framework, ask three questions before making any major financial decision. Question 1. What am I dependent on? Are you dependent only on salary? Dependency creates fragility. Question 2. Is my money beating my real inflation? Look at your family's real expenses, not just the official averages. Question 3. Am I investing with emotion or structure? Gold, because everyone buys it. Emotion is not a strategy. So here are the 5 decoded lessons. Gold is currency, rupee depends on manufacturing. Personal inflation is real, real estate is capital storage, and dependency is risk. India's growth story is powerful, but your personal financial plan must be even more powerful. Review your asset allocation seriously.